Byron, I want to start with something that you tweeted just a few days ago. You said that you were hearing rumors that, quote, the cloud is full, meaning that the chip shortage may actually be hitting some of the infrastructure behind the cloud and this trend of digitization. That would be a big deal. What did you find out?
Right. Well, the demand continues to surge, and great to be back here, especially on a green day in a very choppy 3 months. So thank you for having me. And we are seeing some limited spots where the chip shortage is rolling through to this industry. Specifically right now, GPUs, which are the graphical processor units, or the high-end chipsets that people use for artificial intelligence, machine learning, and also crypto mining, in some cases are seeing that backlog build, and some of the availability zones in the Azure IS zones and some others are having difficulty in provisioning because of the backlog. It's not yet more widespread, and obviously one of the benefits of cloud and the IaaS layer is infinite scalability, and so this would be a major story if we see more backlog build. But right now we're seeing it in very specific areas, and the demand surge that we see is continuing, which is, of course, putting that upper supply chain pressure on.
Right. So, Byron, which companies are best positioned to deal with it if we do see this start to become a problem, more intense shortages? The tech giants obviously are big players in this. Are there some other companies, perhaps under the radar, that could deal with the specific areas you're mentioning?
So I think there's two pieces to that. One is which companies specifically, as you see these potential supply chain surges, certainly those would, with the large IaaS buys, including potentially some alternate clouds, or you could see workloads rotate to CPUs as opposed to GPUs on the margin. But I think the more general trends that we're seeing also go to efficient businesses in this broader tech rotation that you've been talking about and we've been witnessing for the last 90 or so days. Overall, businesses right now that are able to scale efficiently are the ones that are being rewarded. And we're seeing this trade-off where people were in a growth at all costs mindset as recently as 3 months ago, have very much now oriented towards efficient growers. And we're seeing pressure on the fundamentals of the business, and free cash flow ultimately is going to become an equal weight to growth.
Yeah, I was going to say, in a world, we're exiting sort of a period where we were shooting way down the field for a touchdown. Now it's much more about short-term tactical moves, maintaining your cash flow, not letting cash burn go too high. Is there a new magic metric for the whole space right now, Byron?
Well, if you do a regression on the multiples, what you used to see was this 2-to-1 willingness to pay for growth versus free cash flow or net income. That's moved back to about 1-to-1. So in our world, we think of these efficiency metrics in which dials are being rewarded. People with the interest rate concerns are less willing to bet on forward free cash flows and future growth. They want to see it now. And so ultimately, these businesses that are able to scale while generating free cash flow, and in the cloud world, it's companies like Zscaler, Atlassian, Datadog, CrowdStrike, companies like that are generating 20 to 40% cash flow margins while still growing at pretty impressive rates. Those are the ones that have been a little more resistant to this pullback, whereas some of the high flyers like the C3 AIs and the Asanas and the Fastly's have pulled back 50% plus from their highs over the last year, as people are now in this mindset of show us the money, and we want to see quick returns on those investments, and we're less willing to give you 2, 3, 4 years for payback or for ultimate profitability.